Hey, good afternoon, everyone. This is Mark from Right Line Trading, and I really appreciate you giving me your time this afternoon. And I'm here to talk to you about, I think, what you're going to find is really an amazingly powerful indicator that's going to be of significant benefit to you when you trade. This is our web address, www.rightlinetrading.com, info@rightlinetrading.com. Here's our phone number. Unfortunately, just some quick disclaimers that, we are not certified trading advisors. Obviously, be careful because there's a significant risk associated with trading futures, forex, or stocks. We recommend that you talk to a certified financial counselor, and everything that we talk about is for educational purposes only. So with that said, let me just give you a little bit of background about myself. I'm a graduate of the University of Pennsylvania, former professor at Jefferson University in Philadelphia, and I've been involved in the financial markets for over 20 years. And I began trading the futures and forex markets about 10 years ago. Actually, in about 2004 is when I first really became heavily involved. And what our mandate here at Right Line Trading is the optimization of closed systems, and what my graduate work consisted of. And I just want to say that if you have a question, just type it in, and I'm going to answer all the questions at the end, and I'll go through everything. And our mandate is to optimize a closed system. Now, there's strict mathematical parameters for doing that. And what I did in my graduate work was I optimized underwater decompression schedules for the US Navy. And what I saw when I watched the markets move was that each individual market in and of itself is a closed system. And what determines the future movement of price is certain independent variables. And if you determine what those independent variables are, and you place them in a multivariable equation, then you can then, with great precision, determine where price is going to move out into the future. And one of the problems with swing trading and day trading is that you have an enormous number of commercial traders looking at indicators that are lagging. They tell you where the market has been, but they don't have any predictive power in telling you where the market is going. So what we do is we look to create instruments and indicators that help us determine where price is going to move out into the future. Now, this is where the three-line indicator comes in. And I want to talk a little bit about each line. The first line is the multi-time frame assessment of momentum. Now, I'm going to show you some slides about it, and I'm going to show you some trades. But what it does is, the reason it has predictive power in determining where price is going to move out into the future is it doesn't look at anything that takes place on your trading chart. It looks at the two higher time frames to create its bias. And it uses a MACD system on the two higher time frames than the one you're trading. So just to give you an example, if you're trading a 3-minute, it's going to look at the 9-minute and the 27-minute. And it's going to look at the dual MACD system on those two higher time frames. If you're trading a 5 range, it's going to look at the two higher fib numbers. It's going to look at an 8 range and a 13 range. You're trading a 377 tick, it's going to look at the two higher fibs, a 610 and then a higher fib number. So this indicator is assimilating data from price movement and from indicators that are moving on two higher time frames. So the first line is momentum, the second line is stochastic, and the third line is order flow. Now, when the line is red, it means whatever assessment is being made on the 3 line, it is down on both higher time frames. When it's green, it's up on both higher time frames. And when it's yellow, they're just not in sync. One higher time frame may be moving up, the other higher time frame may be moving down. This is a great time not to trade, because what you're going to find is when these independent forces that come to bear on price don't align, price oftentimes just chops. And what you're looking for is a very low risk, potentially high reward trade. Now, first, let's take a look at order flow. Now, there's lots of different ways. I see a lot of software telling you that they do order flow tracking or order flow analytics. And there are lots of ways of doing it. But I think that the way we do it, I'm a little prejudiced, but I think that we do it in the most powerful way possible. Now you can see this is not a moving average. This is simply the absolute value. This is plotting the absolute value of the delta above each candle. And what this delta tells you is whether there's an overabundance of aggressive buyers or an overabundance of aggressive sellers. When the number is green, there's an overabundance of buyers. When it's red, there's an overabundance of sellers. And this line, and which is the way 99% of these instruments track the delta, is they just give you the absolute value of the delta, which doesn't have any predictive value moving out into the future. In addition, the delta itself doesn't tell you whether the candle is going to close up or down. There can be an overabundance of aggressive buyers on a down candle and an overabundance of aggressive sellers on an up candle. So if you're looking at the delta, which again is the disparity between aggressive buyers and aggressive sellers on each individual candle, and some platforms even break it down into tick value, or on stocks on cent value, or on Forex on pip value, and use that to track order flow and order flow analytics. Now, what we have found is that the buy-sell disparity on a tick level doesn't carry any predictive value in telling you where price is going to move out into the future. In fact, on your trading chart, neither does the delta itself. It just changes dramatically, and the absolute value of this number does not tell you whether the candle is going to close up or down. So what we've done, again, let's say you're trading at 3 minutes. We look at the 9-minute and the 27-minute. And we look at the delta value of each candle that's created, and we put that in a 15-period moving average, and we create a delta moving average of the two higher time frames. Now, when that delta moving average is moving up on both higher time frames, you have significant buying pressure on price. And when that delta moving average is moving down on both higher time frames, you have significant selling pressure on price. So that one outlier where you get a down candle with a positive delta, or an up candle with a negative delta, is smoothed in that 15 period. And the 15 period is fast enough to be able to take turns and track price really accurately. So this gives you a tremendous amount of predictive power. Now, if you look right here, this is the E-mini, and I made this in February, actually of last year. Now, there are no values above the candles because we're not using any of these values. So we turn them off, and you're not going to see them on your trading chart because they're just going to, if the information doesn't provide you data to help you trade, there's no reason to see it. You've got enough visual overload anyway. So it's not even going to display. So for what you're looking here now is the delta moving average of the two higher time frames. And you can see when the delta moving average, this is a 5 range, it's looking at the 8 range and the 13 range. So it has tremendous future predictive value because price on your trading chart is going to move out into the direction of your two higher time frames when they align. Now, when order flow is aligned to the upside, and this only gives you a directional bias, doesn't give you an entry, you have to trade long. When order flow is aligned to the downside on your two higher time frames, you must trade short or you're going to get stopped out. And again, to the upside, you must trade long. Now, here's another example. When order flow is aligned to the upside and price right here is hitting upside resistance, you've got to wait for the break of resistance. It's a 2/3 candle close above an area of resistance. That's Japanese candlestick dogma. And you can take that first break long in the direction of order flow. This is going to tell you where price is going to move out into the future. It is a leading indicator, not a lagging one. Now, this is actually a live trade I took in the direction of order flow short on crude, and this went 18 ticks. Again, here's what you have to do. If you're sitting on support, you have to wait for a break of support. You take potentially what might be a counter trend trade. You can only go short when order flow is aligned to the downside, to support, and then out. And then when trade aligns for a trade-off support long, you can only go long when order flow is aligned to the upside. And here, you're trading off resistance, only short. And you can see all the traders in these counter trend trades. When order flow is aligned to the downside, they're in these green candles going long. They're getting stopped out, stopped out, stopped out. And what they're doing is they're trading oscillator divergence, MACD divergence. Maybe they're trading Fibonacci support or resistance. But if you're not trading in the direction of order flow, you're taking a very, very high risk trade that's very likely going to get you run over. Here's another trade. Candle sits on support. It's only going to be a long trade right up to resistance. Now, if you want to take this counter trend trade, you have to wait for order flow to turn. And you can see how there's your short candle with the turn of the delta moving averages of the two higher time frames. Now you're going to exit at support. That's the conservative way to trade. Or at least you're going to take, if you're trading 4 contracts, maybe you'll take 2 out here, maybe 3, maybe anticipate a bounce. And if order flow stays red, anticipate a break of support to the downside. Your next anticipated trade would be a move up to resistance and a short if order flow is red. Now, I wanted to talk a little bit about stochastic. Stochastic, I'm sorry, this is the MACD. Let me get it straight. Now, the MACD, when you use a MACD on your trading chart, essentially does not have any future predictive ability to tell you where price is going to move out into the future. And it tells you where price has been. Now you can see this black line. This black line demarcates the MACD crossover. The purple line is the actual MACD, and the green line is the signal line. And when the signal line crosses the MACD line, you should take a short trade. But if you did, you would go nowhere because price is only going to go up, irrespective of what the MACD is telling you. In addition, I think we all know how bad divergence is. Now you get divergence right here. You get a higher high, but the MACD creates a lower high. And if you traded divergence, you get run right over. And look at this huge divergence signal. These are equal highs, and the MACD is tracing out a much lower high. And you still get run over. Now we looked at stochastic divergence and MACD divergence in order to determine if they have any predictive value on your trading chart or on higher time frames. What we found was that MACD divergence fails so often that it is better off being ignored than even being used as a warning signal to have you stand aside on a trade. So a MACD divergence signal or a crossover on your trading chart has absolutely no ability to give you a great trade. It's not going to increase your trading precision. It's going to give you some winners, but it's going to hand you multiple losers. So what we do is we look at the MACD of the two higher time frames and ignore any divergence signal. Now, the MACD is a great momentum indicator, and it does have validity as long as it's tracing out price on the two higher time frames and not on your trading chart. Now we have two lines. The upper line is MACD, or momentum, and the lower line is order flow. So what we're adding is specificity to the trading entry. So when they align, the probability of getting a winner increases, and you get better trading entries. Only long. It's giving you an absolute direction to trade in. Same thing here. This is the E-mini, actually. This is a gigantic long move. Order flow and momentum stayed long throughout the move. And all these traders are trapped in the counter trend direction. And if you try to call a top here, as long as order flow and momentum stay aligned to the upside, you're going to get run over. The only time that you can try to call a counter trend trade is when order flow and momentum both together rotate the red. When they do, then you can try to call a potential counter trend trade. I personally am not fond of counter trend trades. I like to trend trade. But if you're even going to think about it, you can't do it until order flow and momentum turn. Here's the same thing. Huge trade to the downside in the direction of order flow and momentum. Now, what's really important, again, and I want to emphasize, is that these two lines don't turn red because price is falling, because this is not assessing price on your trading chart. It's looking at price on your two higher time frames. So price is falling because these lines are red. That's what makes these independent variables. You see lots of software that it's going to turn, it's going to turn red. The background is going to turn red when price falls, simply because it's based on some MACD crossover, whatever. All it is doing is telling you what you already know. This is giving you an absolute direction to trade in. And again, you have all these counter trend traders stuck in the wrong direction, and they are almost guaranteed to get run over. Now, I wanted you to see here what happens when two independent forces that govern the future movement of price don't align. Here you have momentum to the downside. Here you have order flow to the upside. And this is why you must stand aside when this happens. because what you do is the market begins to chop. It doesn't know what direction to move in. So when there's no alignment of these two independent variables or independent forces, you have to stand aside. Here's another period of time where there's no alignment and price chops. And as soon as it rolls, it breaks resistance to the upside and up you go. Now, I also want to emphasize it. I'm going to emphasize it over and over again. This is time frame independent. The reason I took the time frames out of here is it does not matter whether you trade a 5 range, a 3-minute, a 4-hour bar. It does not make any difference what market you trade, whether it's futures, forex, or stocks. Order flow and momentum are universal forces that govern the movement of price on any financial instrument and on any time frame. So if you ever see an indicator that you are told is going to predict the future movement of price, but will only do it on one market or 2 markets, or will only do it on certain specific time frames, then you know there's something wrong with it. If this is a real force that governs the future direction of price, it's going to be market independent and time frame independent. This is going to help you trade stocks, futures, and forex. Now, I wanted to talk a little bit about stochastic, because that's the middle line. And what we've done is we've modified the conventional way that a lot of traders look at stochastic, and it's really helped you. It will really help you trade that stochastic line. Now, I don't have a slide of it, but all stochastic does as a momentum indicator is looks at the relationship between the high of the candle and the close on a long move. And as the high of the move approaches the close, momentum's to the upside. Optimally, the close and the high are going to be the same. And as the high of the move and the close of the move begin to separate, then momentum starts to wane, and that's when the oscillator begins to fall. Now, we've made certain, we've agreed to certain conventions, and that is when the market is overbought, the bulls are in control, and the oscillator is always going to stay green in an overbought market and will always stay red in an oversold market. But it will signal potential divergence, because divergence on a higher time frame can be problematic with stochastic. This is a very smart line. Now you can see right here, you have failed divergence. You have equal highs, but this is a stochastic is much lower, and price just comes right down and goes right back up. And this is where MACD divergence failed and stochastic divergence failed. But a higher time frame stochastic divergence does have some predictive power, so we couldn't ignore it. So when it's overbought, that middle line will always stay green. When the market's oversold, it'll always stay red. Otherwise, it's going to tell you whether the signal line is below the stochastic line or above the stochastic line, in between the 20 and 80 levels. Now, in addition, in a strong uptrend or downtrend, potential divergence will trigger a color change in the oscillator line. And let me show it to you. Right here, you have price making a higher high. You have potential divergence. And you see the middle line goes red. So when you have this strong uptrend, and all of a sudden, independently, the single line changes color. It doesn't go to yellow. there's no intermediate color. You can assume that the oscillator is reading divergence on a higher time frame. Now, what I like to do is if I'm in a strong uptrend, and I'm going to talk to you about the 50 and the 15 in a minute, because that's part of the package and part of the software. I'm going to ignore it, but it does signal for you when you do have divergence present. And if you make it a part of your trading plan to stand down on divergence, you're not going to take a trade in a strong uptrend when the oscillator suddenly goes red, or in a strong downtrend when the oscillator suddenly goes green. Now, here is when you have all three forces aligned. And because it's always hard to look down at a line, and what you like to do is, what I like to do, and I'm sure you do, is like to concentrate on price. When the price bars are outlined in this halo, it tells you that the 3 line is in sync, and you should be, and what you're looking for is an optimal long trade, and it's going to be a low probability, a low risk, high reward entry. Now, I want you to look at another convention, and that is, let me go back to MACD for a second. And what we found, going in the wrong direction, is that we only care about the slope of the signal line. Now, some traders will not consider the MACD to be a sell signal until there's a cross of the signal line with the MACD line. We don't agree with that. When the signal line starts down, your anticipation starts to change in the direction you're going to trade. So out of respect for that, here's how the indicator works. It's a smart indicator. You can see that when the first line or momentum is yellow and line 2, stochastic, and line 3, order flow, are both green, your candles are still going to have that up halo color. Now, you can surround your candles in any color you like. And I change colors with different slides. But this is going to tell you that you want to take a pullback to support and a long trade, pull back to support and a long trade every single time. And the likelihood of getting a successful trade is extremely high. So if you have 2 greens and a yellow, you're going to get that up halo, and you can decide whether you want to make it green or light blue or whatever color you like. Again, you can see it right here. When the candles are outlined in black, it means that the 3 line is not aligned. When it's outlined here, I have it in dark orange, it means that it's aligned to the downside. And the downside, like the upside, is 2 reds and a yellow, or 3 reds, or 2 greens and a yellow, or 3 greens. They're all equally as effective. Now, these are just terrific trades. Here's the move up, the pullback, the candles outlined, and this is a winner. Pullback, winner. Another one. Pull back to support, winner. Pull back to support, winner. Pull back to support, winner. This is on the E-mini. Now, I want to talk a little bit about the 50 and the 15, because you're going to get these indicators in this package. This is part of the deal that we're offering. The 50 is simply a 50-period simple moving average. Nothing really that remarkable about it. Not going to spin a story for you. It's just not that amazing. But what it does do is have a certain slope degree. So it tells you whether momentum on your trading chart is down when it's red, flat when it's yellow, and up when it's green. Optimally, you only want to trade long when the 15 is above the 50 and the 50 and the 15 are both green. And when you get that alignment and you get the 3 line with you, you're going to get a lot of real great trades. I'm going to show them to you on a live chart. Now, the 15 is really a pretty remarkable indicator. It's a 15-period moving average, but it's combined with an ADR-ADX indicator. And the ADR-ADX indicator is an assessment of volatility. Now, when the 15 period is flat, it means that volatility is low. You don't want to trade when there's little volatility in the market. It means that you're unlikely to get that real skyrocketing trade that's going to take out all your targets and give you a full winner. Or if you're on a trailing stop, is going to carry you 3, 4, 5 points. So optimally, you want that 15 to be green on a long trade. That's going to decrease the risk and increase the potential reward. So it's really, I think it's an underappreciated indicator. But if you put a 15 period simple and a 15 period exponential over them, they're going to crisscross it. And when they're yellow, they're going to crisscross it. Because all they're doing is chasing price. This embeds not only in price, it also embeds a component of volatility. There's the trades. And I just outlined the candles in green to show you that you can by default create any up color you like. Now you can see that everybody who is in these red candles trying to counter trend trade against the direction of order flow, stochastic, and momentum that's assessed on a multi-time frame basis, looking at the 2 higher time frames, is going to take a 100% bruising on these trades. And it's remarkable how many small commercial traders like us consistently trade in the wrong direction. And I can guarantee you there are no institutional traders caught in that direction, because they're the ones that are creating this uptrend. When these align, it usually requires institutional money. So these are just the small guys creating these individual down candles and getting run over. Now that's a trade I took live, and that was a 2.5 point trade. And I don't want to make this a real complex. That's a full system. Now let me take these down. And I'm going to take these down. And I'm going to show you a chart. And I can show you any market you like. Here is the E-mini today. Now, I just want you to be aware of one thing, and that is, just let me take off all the print. And that is, when you open and close a fractal indicator on NinjaTrader, it recalibrates it. And that's a flaw in the platform. It shifts everything 1 candle to the right. When you're trading live and it's looking at it's doing a multi-time frame analysis, it's going to look at the candle that's formed versus the candle that's forming into the future. When you close and reopen, it looks at the candle that's formed and the past candle. So it pushes everything to the right a little bit. So the colors are not exactly the same when you reopen the chart. But you can see right here, now I took all these trades in the room this morning. I went short here. I went short here. And I went short here. 3 winners in a row. Bang, bang, bang. Now, it's simply because I'm concerned about taking a 4th retracement in the trend, I did not take this trade short. But I went short, short, and short. And all 3 of these trades or with the 3 line, which I don't trade against. And I'll just show you real quickly. This is exactly what we got in the room. Oops. Sorry. I don't know why I did that. Hang on one second. And we made nice money here. This is the ruler. We made 1.5 points. Now, if I had a bigger automatic trade management strategy, I could have captured the whole move. But I'm out on a reversal candle. I made 1.75 points. And this was the biggest trade down to here. I made 2.25 points. So about 6 points right here on this move down. This is another trade I took right here. Right off support. And I'm not making it up. These are all trades I took in the room. 2 points. In the direction of stochastic order flow and momentum of the 2 higher time frames, my 50 and my 15 were green. I had sideways movement, a consolidative pattern, right into support. I always want to trade off of the support of the 15 and a perfect long trade. Now, if I would have taken any of these trades, none of them would have stopped out, but they're still just a little too risky for me. I want to trade right off support, a tick or two off support. There's another trade I took. I had an enormous number of winners this morning. If you're in the room, you know that. 3 points. And I had another 3-point winner. Let me find it. Right here. Now, this is a risky trade. Right here. Because we want that 15 to cross the 50 to the downside before we take a short trade. Now, part of the package is you're going to come into the room and you're going to trade with me in the room. And you're going to see how we leverage this on futures. And then it's going to be very easy for you to leverage it on stocks or Forex, whatever markets that you like to trade. But I had the 15 down and the 50 down. And although it had increased risk, because I want that 15 to be on the side of my trade, this was an enormous winner. It's 5.75 points. Now, I could do this all day for you. Now, this was before the room opened, because we don't trade until the NYSE opens. Here's short. Here's short. And here's short. And if you try to counter trade when the 3-line indicator is pink and this candle is outlined in what I color it, I'll show you right. I'll show you the inputs. Whoops, didn't open them. Hold on. Here they are. Here's the 3-line. I have dark orange and deep sky blue as my default color. Bam, bam, bam. 50's red. 15 is red. 15's crossed the 50 to the downside. Now the 15 is still green, but it's rolling. 3 perfect trades. And you'll notice that when you trade in the direction of the 3-line, and this is a live chart, this was a real market, this is real price, you almost never get stopped out because you're never caught in the counter trend direction. You could have gone long there or there, and would it have taken you, based on your ATM, at least to here. Now, you don't have a trade here. You don't have the 3-line. See, it's colored in black, and you don't have one here. Occasionally, it's going to keep you out of a winner. But that's a good price to pay for keeping you out of an enormous number of losers. And you have the same thing here. Now, the reason you don't have this color is because you got stochastic divergence. And here's a great example right here of it. You're in a strong downtrend, and all of a sudden, out of the clear blue, that middle line goes green. I would ignore it because I'm going to bet that divergence is going to get run over. There's a short, there's a short, there's a short. And I could do this all day. Now that's a tough trade to take. If you're a gambler, but that's a tough trade. You don't have a clear-cut pivot. You just have to be patient. And you see these trades come down, down, down. And they look like mirror images of them. Look at this long trade. And the three line is always going to validate the trade. So you can see the predictive power of it. Now I'm going to move it to crude oil just to show you, and then I'm going to open it up to questions. Then I'll show you the offer, and then any other, if you want to trade any other instruments, if you want to look at the NASDAQ or the Dow or whatever you want to look at, we can look at, because it doesn't make any difference what market you trade. You're going to get the same results. Now, the only thing that we have to change on crude is we trade an 8 range. You can trade a 3-minute, a 9-minute. In fact, I should show it to you on a 3-minute. Now, this is a trade I didn't take this morning, right here. It's a little too risky for me because the 15 hadn't crossed the 50. But look at the trade. I stood down on that trade. Now, I stood down on that trade because I didn't have the 15 crossing the 50. But that was a trade. I won't use it, and down. And there was another one here. I think this was the other one. And right here, this is early in the morning before we open the room. Perfect short trade. Right there. Now here, I would go short because I'm just getting that crossover. And there's a beautiful trade to the downside. And you can see when the market's caught up in chop, the 3 line, see these candles are all outlined in black. When they're outlined in black, you just stand down. You don't even have to look at the 3 line indicator. Just look at the candle color. And the candle color is, you're going to get that intra-candle. In fact, these candles are never going to be colored anything but dark orange. And there's your trade right there. And that's a very, very big winner. There's your trade. That's a very big winner. Now, let me just go to the offer. And then I'm going to go to questions. And if you want me to show any other markets, let me just show you one other time frame. Instead of trading an 8 range, let's trade a 3-minute. We'll trade a 2-minute. Here's a 2-minute on crude. And you can see you get the same. Here's a pullback to support and a long trade. And obviously, I don't like time, but it's definitely tradable. It's a little bit tougher for me to trade time-based charts. But the validity of the signal is still just as good. Now, here's your short trade on time, right here. Pull back to resistance, and your short trade, right here. That's a big trade. Let me see how big it is. Your entry is going to be right here. That's 33 ticks. I mean, that's a day maker right there. This is just a night. I'm not even going to look at the middle of the night. And really nothing is aligning. I'm just looking for the 15 and the 50 to be red. I mean, this is a signal. It's not a huge move, but it should be a first target. This I believe probably occurred because of the fractal indicator recalibrating, but there's your trade out of consolidation and up. I don't know how many days we have. So it doesn't make any difference what you trade. So let me just show you our offer. Let me go back to tick because I really like range bars. Let's go to the 8 range. Now the indicator knows what time frame you're trading. It's built into the algorithm. So you don't, our old V1 indicator, you used to have to put in your second highest time frame in order to make it work. This one, you don't have to do that at all. You see, I screwed up the bars, but let me see if you have any questions. Hold on a second. Let me just go to the slides. Let me just scroll down here. To show you what we're offering. Now, the indicator is normally $7.99, and we're giving it to you for $399. Now that includes all upgrades and add-ons. Now this is the V2. About a month ago, we had the V1, and we just released the V2, and we're always looking to make these things better. In this indicator, it assesses stochastic divergence. It makes assumptions about an overbought, oversold stochastic. I mean, it helps you interpret the stochastic without having to do the annoying multi-time frame analysis of stochastic on your own. It does the same thing with order flow. And to create a delta moving average of your 2 higher time frames is not simple. Now, there's a lot of people in the room. There's 125 people in the room. The first 10 orders will also get a month in the training room with me. You're also going to get our 10-module weekly educational training session, which is live, and you're going to learn our trading methodology from the ground up. And it's different from other methodologies. We only look at multi-time frame analysis. And we discard a lot of things that the small commercial traders have been using for a decade or more, and what's caused all of those traders to walk off the cliff. And that's why 95% of day traders fail. The things that we use, we have assessed mathematically to be effective. So you're going to unlearn a lot of the bad stuff or the toxic stuff, and I'm going to try to fill your head with things that are only going to increase the precision of your trading entries. And you're also going to get that 50 period SMA colored, and you're going to get that 15 period proprietary moving average. And we do charge $300 for that, because that is a very, very unique line. No one has ever been able to duplicate it. And when I first rolled it out 4 years ago, the ADX component used to splay up away from the 15 period. I mean, it just wasn't coded exactly, and since then we've touched it up. But it's a pretty complex indicator. It does a lot of work for you, and and the assessment of volatility is really important in taking your trades. I mean, I've seen a lot of YouTube videos where traders work with that volatility indicator to try to only take a trade in a volatile market. Well, it's built into the 15 period. So the first 10 will get all that for the $3.99. Now let me see if there are any questions. Now, every trade that I take in the live room, 99 out of 100 trades will always have the 3 line with it. Every now and then, I'll let 1 line go. But for all intents and purposes, it's an essential component of my trading entry because I know it's going to decrease risk and it's going to increase the potential reward I get when I have all these forces aligned. And I know if I don't have them all, then the market has a tendency to move and chop, and I'm more likely to get chopped out of the trade. So I'm very, very careful when I trade to make sure I've got that candle color, and then I'm just looking for a pullback to resistance and a short, or a pullback to support and a long when the 15 is above the 50, and a short when the 15 is below the 50. So let me see if I have any questions. Now, I just want you to also know that we will configure the whole indicator for you. Now we work on NinjaTrader 7, NinjaTrader 8, and on Sierra charts. Okay, hang on. I have some questions here. No. Jan, that's a really good question. Is the technical software just for day trading? It is not, because it works on any time frame. So if you want to use it to swing trade, I use it to trade options. I have an options alert newsletter, which is done last year. We made 105% on my options alert. And I use it on 4-hour bars to swing trade options. Now just let me reconfigure these a little bit to make it easier. So it's not a day trading tool. You can use it also as a swing trading tool. You're going to get fewer entries if you trade higher time frames. But like I said, if an indicator is not time frame independent and market independent, it can't really work. It's got some finagle factor in it. Do you combine this with market profile? On the full platform, Pizzazz, we do. We do. Now, I mean, that's the full software. What I'm looking for is to have you integrate this into whatever trading methodology or trading strategy that you do. I mean, if you're interested in market profile, I don't want to confuse anybody, but that's a separate indicator and not included. But I'll show it to you real quickly. We have a remarkable market profile. If I can find it, I'll put it in real quickly for you. Because that's a very, very good question. Because we do, right here. Whoops, it's not. I want to answer all the questions. There's market profile. It shows you the low of day. It shows you the high of day. Here's the point of control. Here's the value area. This is actually the value area low, I believe. These are low volume nodes. It shows you everything. And here's the volume profile. So yes, we do use it. And I consider that also an important component of trading. If you want the full indicator suite, that would come with it. So yes, that's my answer. Sure, Joe. Oh, okay. Now, Pizzazz, it will work with Renko bars as long as the Renko bar has a wick. I want you to understand something about Renko bars, because this is one, I consider this to be a scam. In order for an oscillator to work, it must have 4 components to it on every candle. The candle must have a high, it must have a low, it must have an open, and it must have a close. If it doesn't have these four parameters, then the formula for the oscillator will not function. So on a standard Renko brick, I see all this software that costs $15,000 with an oscillator down below standard Renko bricks, and all it's doing is tracing out the exact price. But if it's like a wicked Renko or a modified Renko, and there's actually a wick to create a high and a low, as well as an open and a close, then it will work on a Renko. But it will not work on a Renko brick, because all there is on a Renko brick is an open and a close. There's no high and there's no low, and the formula for the oscillator does not function. So it doesn't work on standard Renko. It's compatible, PS, I think I mentioned on NinjaTrader 7, NinjaTrader 8, and with Sierra. Right now, Van, it won't. Just those three. Now, if you're really interested in it, you could set up a NinjaTrader demo and get a free data feed and trade off the signals. A lot of traders do that. You don't have to pay anything. And a demo, since you're not trading off of it, will work great for you. As long as you trade off your primary platform that has your broker attached to it. I mean, that is a really viable alternative. Sure, Ford. Ford says I have the issue of risk to reward at the time in the market. Ford, listen to me. It helps immeasurably. And let me tell you, trading is all about the potential risk to reward. And I'm going to show you something else. I don't want to diverge from my original topic, but let me show you something. And this is what you're going to get, and this is just a small component of what you're going to learn in trading school in that 10-module series. And that is this. When are you likely to get? Now, an oscillator does not define an overbought, oversold market. I'm telling you, it does not. What defines overbought and oversold are these parameters. The market will continue to fall as long as order flow and stochastic and momentum are down. These are what define overbought and oversold. Now, the other component that you're going to learn is the difference between the 50 and the 15. Now, I'm going to show you something else I shouldn't, but I'll show it to you anyway. And I really don't want to, I diverge, and then I get into lots of trouble. Hold on a minute. But I'm going to show you what defines a low risk, high reward trade. Because it's going to jump out and bite you on the nose. Hang on a second here. Now, do you see this? This is called the MA diff. In ticks, this tells you the difference in ticks between the 50 and the 15. Now, it's always reading that number off the right edge. So, we want to trade the market when the MA diff here on an 8 range is 21 or less. But when you get a trade like this, here's an entry, but look at the space between the 50 and the 15. In ticks, it's real tiny. It's only 4 ticks. And look at the size of the trade. It's not an accident that this entry gets you a 27-tick trade, because the space between the 15 and the 50 is so small. This is where the market has a chance to run big time. And this is why, well, I don't know why my CQG is about to close, but it doesn't matter. I don't need any live data. Now, with the 15 and the 50 here, huge. Now it's 22 ticks. Now we know we're oversold. And we're not going to trade short anymore. Now we're going to look for a retracement and for the market to reload and give us another short trade, which it does right here. So that's a very clear way of defining risk to reward. When you're marginally oversold or marginally overbought, you're unlikely to get a big runner. And so this is on a statistical basis. This is 13 ticks. Maximum is 21. It doesn't have the potential reward of the other trade, but it still has nice, and look how far it goes. And there, it's right at you. The risk you take versus the potential reward. And you can see the trade is right off the value area low. A great area for a break, retest of resistance, and a continuation down in the direction of the 3 line. Now, God only knows who's taking this trade, but there are enough buyers here to create an up candle because they're deciding that the market has gone as far down as it's going to go, and they're calling a bottom. And they're always going to get beat up. They called the bottom here. They called the bottom here. And they're all gone from the market. This is what we don't want to be. So the MA diff defines the space between the 50 and the 15. The low risk, high reward trades comes when these are small and the 3 line aligns and you trade a short right off resistance or a long right off support. That's not to say that occasionally a great trade won't blow up on you. Because, every now and then you're going to get a loser. But as long as you stay focused and continue to apply a lot of diligence and a lot of discipline, you're going to accrue lots of winners. So there it is. If you were concerned, Ford, about your risk to reward, it's right there in front of you. Market structure and the indicators define it for you. And if you're going to take a short trade with the MA diff 21, you may squeeze out a first target, but the best thing to do is stand down. Leave it alone. When the MA diff is 5, 6, 7, here it's 13, you go short. You don't squeeze it. I mean, if you tried to take this trade right here, short, went nowhere. It went right into the lower day. We don't trade into that anyway in general. And signaled to move back up. So we don't go short into an oversold market or buy an overbought market. And we don't trade into the lower day or higher day. That's real dangerous. And let me just say one other thing. And this is also part of trading school. What's our primary goal? Is it to get winners? No, it's not to get winners. Our primary goal in trading is to avoid losers. If you can avoid losers, you will make a lot of money. And that's why most day traders do not understand what their mandate is. They think they're going to go in there every morning and they want to get winners. But their goal is not to get winners. Our goal is to avoid risk because we don't want to take losers. And if you avoid losers, those perfect trades will come at you and you're going to get them and they're going to run. The 3 line, the 15 and the 50 as standalones will define that for you really well. Sure they do, Ford. I just showed you exactly how that works. The space between these two are critical. Now, the space between an SMA and an EMA is useless because they simply track price too fast. This is a really, really unique 15. And when it's red and rolling, it shows that you've got huge downside. Well, it shows that you have a lot of volatility. Volatility is skyrocketing here because the 15 has got a lot of slope to it. And there's also the fact that price is falling hard. So they're great signals to trade. They help you a lot in trading. The EMA and the SMA don't do this. And I'll just tell you as an aside, and I'm giving you some information from trading school. Price moves as a first or is a first order moves in a first order manner. It doesn't move in an exponential manner. The exponential moving average is actually a curse, and the person that invented it should be taken out and put in front of a firing squad, because nothing moves as the square, a to the second power, a to the third power. This is not the way price moves. Price moves in an arithmetic way, not in a geometric way. So I wouldn't even look at an exponential. And the simple just doesn't track price the way the 15 does. Exits PS, we have recommended automated trade management strategies that Sergio is going to program for you. Because my desire is capital preservation. Now, what we do is, and so I have a very, very conservative automated trade management strategy. It really is conservative. Now, on an 8-tick candle, you must take a 10-tick stop. It's absolutely mandatory based on market structure, because the higher the candle creates a small area of resistance. So you have to break the candle to the upside. And a lot of times it'll come back 8 or 9 and then come back. So risk is fairly set, but reward is based on the average true range of your trading instrument. So we have big targets on crude and more modest targets on the E-mini. And we try to keep the risk to reward about 1-to-1. On stocks, they're 4 or 5-to-1. But on a leveraged instrument like Forex and futures, you just can't get better than a 1-to-1. Because, for leveraging a small amount of money, you can make $10 a tick, which is an amazing amount of money, only utilizing a small amount of margin. And so you just can't do better. But if one winner equals one loser, you're doing great. And we're going to give you all those settings. A Flex Renko, Rich, I don't know, as long as it has a wick. That's all it needs. The system will read the wick as, the higher the low, and the Renko brick itself will be the open and the close. So as long as it's configured with a wick, it'll work. I'm sorry, Ford, do you currency futures have any focus? I'm sorry, can you retype that? I'm not sure what you mean by that. Do currency futures? Let me tell you, we have an auto trader that trades all the currencies. I didn't put any up here. I don't have them in my instrument manager, but our auto trader trades the 6E, the 6C, and the 6J. And it does real well with them. So these work great on the currencies. And I don't want to draw this out too much longer, but I'll quickly put a currency in, and I'll show you. They really do well. I'll put in the 6E. All right, it's in, I believe, and closed. And I'll show you the 6E right here. Now, in the live trading room, I watch crude and the E-mini, and I just don't have the ability to watch more markets than that. And every now and then, I missed an entry this morning on crude. That was really just a terrific entry, but I was watching the E-mini. Now, we trade the currencies on a 5 range. And there's your entry. You have to go to the right edge in order to see where market profile is. And there's one entry right here. Pull back to resistance and short. Another entry right here. Pull back to resistance. And we look for a single candle retracement, not a multi-candle, one candle. You see here is a potential short, but the 3 line isn't with us. Another potential short, the 3 line is not with us. Here, the 3 line is with us, and bam, get a big trade. Here's another short right off the point of control. Not a huge trade, but it's a winner. We'll take it. And there's your terrific long. It's a multi-candle back, 2 candles back, but up you go. Up you go. So you can see you get great entries on the 6E. And speaking to you, Ford, the MA diff here is only 13. Small. This is a riskier trade. This is the one we would anticipate would have low risk and high reward. And I mean, listen, I really could do this all day because I'm telling you, when they set up, they very, very rarely lose. I mean, here's a short. It's not a huge trade, but it's a winner. Now, here's a loser. You get top ticked out. Well, that's a double top. It doesn't take you out. Let me see if it's going to get you a first target. I don't know. You're going to go in here, and this might be a loser. This might be the first loser we find. Yep, that's a loser. Now, it's 5 o'clock in the morning, but it's a loser. And there's a winner. Retracement and continuation. And here's where you get your big trades. When the 15 and the 50 are close. Right here. Right here. Right here. So it doesn't make any difference. The 6J and the 6C are all the same. So listen, I really appreciate Sure, Ford. I totally agree with you. Listen, the 6E trades very, very well. You should get lots of nice winners, especially in the early morning. 4 or 5 o'clock in the morning, 6 o'clock in the morning, the 6E moves real nice. Okay, Jan, does trading the E-mini futures require a large balance and day trading minimum account like stock options? No. You can trade, if you want, Jan, you can trade 2 contracts on the E-mini. It only requires $400 of margin per contract. That requires $800 in your account. You can easily trade with $2,500 because you're going to only use $800 every time you take a trade. So you can trade the E-mini futures with a small account. Crude is $1,000 a contract. And if you trade if you trade 2 contracts there, you're going to require $2,000 of margin. So you're going to have to push your account closer to $3,500. Okay. Here's what it means, PS. Let's say you're going to trade, and this is just based on market structure. Let's say now this is not a trade. But I want you to understand this. The bottom of this candle, since this is a long candle, acts as a weak area of support. So when price comes back, it can come back to the base of the candle and it hits support. So we don't want to get stopped out. Now our entry is one tick above the close. The candle closes here, our entry would be here. So we don't want to lose the trade until price goes one tick, I'm just going to close that, comes one tick lower than our entry. So the space between our entry and one tick below the open is 10 ticks. That's what defines your stop. If you try to put the stop 4 or 5 ticks, then you're just within the natural harmonic of the market. It could come back 3 or 4 ticks and go 25 on you. If this candle breaks the low, I consider the trade to be broken and the market in free fall. So the potential is that price could go all the way down. But as long as it's intra-candle and price is just kind of, moving around inside this candle, that's just normal flip-flopping of the market. I mean, not every trade is going to hit your stop and fly, although a lot of them do. Some of them don't. Occasionally, you're going to get stopped out. But if you really want to trade with rigorous market structure, and we do, an 8-tick requires a 10-tick stop, and our 5 requires a 7-tick stop. Although in the E-mini, we get around that, and we only take a 6-tick stop. And we actually steal a tick from the market. But I can't go into that now, because it would take me about 40 minutes to explain it to you. But we do steal a tick from the market on the E-mini. But we can't do that on crude. So that's what defines that stop. And that's an honest stop. And if you try to get a smaller one, you're going to lose a lot of trades intra-candle that are going to turn out to be winners. So I hope that makes sense. Sure. So listen, everyone, I hope you'll come aboard. I'll show you the offer one more time. And I think it's important that we not only give you the indicators, but I provide you with a lot of educational support. Because I think what you want to do is you want to learn how to trade. And you get taught a lot of really toxic stuff by a lot of trading rooms. So again, it's a month in the trading room with me. We make money almost every day, not every day, but almost. You're going to have 10 hours of education, an hour a week, and you're going to get that 50 period and that 15 period, which we never give away. So you're going to get actually 3 indicators, and it's $3.99. So, and that's only for the first 10. So I hope I've answered all your questions. I wanted to get off of JPEGs and slides, because what really tells the story is a live market, is to show you the charts and to show you the entries, and not to cherry pick a JPEG that I chose just because it was a winner. I want you to see that what I'm telling you really does make sense and does work. And if you take trades in the direction of these 3 forces, order flow, stochastic, and momentum, you're going to really increase the probability of getting a winner.
The link is in chat.
Now the buy link is in the chat if you'd like to do it. I think I hope you can see it. If you can't see it, can you guys see it? Okay, great. That's it. And listen, we welcome you. And listen, we're also not people who disappear under a rock. I'm here about 9 to 10 hours a day. Rory's here 9 to 10 hours a day. Sergio's here. Brune is here. If you have any questions, any issues, we're always here. And anytime we upgrade or do an add-on, you get it. We never. Eventually, we're going to come out with a 3-line V3. We're never going to ask you for more money for the upgrade or the add-on. You're always going to get that as part of the deal. And we've been doing that. I mean, the company's now close to 5 years old. We've been doing that for 5 straight years. Everybody who originally bought the original 3-line got the V1, and now they get the V2. So listen, have a really, really great afternoon. I look forward to having you come aboard. And listen, I am looking to make us money. I'm in the trading room to hit a profit every day. I trade with Chart Trader Up. Our stops and targets are projected. I call out all the trades well in advance. Everybody is in them. You know, it's not a retrospective room. It is not an educational room where you will learn. Our goal in the trading room is to make money, numero uno. And then right after that, our goal is to learn. So at the end, we do a complete review of all the entries. A lot of traders always say, how come I didn't take this? How come I didn't take that? And sometimes I miss a trade. So it's really nice. I mean, I get a lot of feedback. Some traders take trades I don't because I think they're too risky, and some traders find trades I miss. So we always do a review of the full E-mini and the full crude. I show you my NinjaTrader back end. We're totally transparent. We show you the profit loss on every single trade, and Chart Trader is always projected. So nothing is hidden, and everything is right out there. And when we take a bad day, you know, we wear that bee sting on the tip of our nose. We don't hide it, and you can see our profit loss on every trade. So listen, everyone, have a really, really great afternoon. And the trade room van, it starts usually about a quarter after to 20 after 9. We go to our profit target, and a lot of traders want to push past it. On Monday, we made $640 in 35 minutes. I did not want to go past. So we've traded for 35 minutes. Today, we traded for almost 2.5 hours. Sometimes I'll trade into the afternoon because my goal is to walk away every day with money. In general, though, we start right when the NYSE opens, and hopefully we've walked away with a nice profit by 11:30. So it runs about two hours, and that's Eastern Standard Time. But I am willing to trade until we make money. And I'll just say one more thing. In this really choppy, difficult market, we have been blowing it away with the 3-line indicator. In chop, it doesn't align. We stand aside, and a lot of these trades blow up. And the E-mini has been moving like up and down and just tremendous volatility. I lost a trade today. I had a 4-tick first target. It went 3 ticks, and then someone burped 9 candles. 9 candles in under a second or two, and it took us out of the trade. There's nothing I could do about that. But that's how tough it's been to trade. We've been doing really well. We made 2,050 last week, and I think we can make close to $2 grand this week as well. Yup, it's been crazy but I'm going to tell you, if you come into the room, you're going to see we handle it. We really do. We wait for that 15 in the 50 to align. We wait for our 3-line to align. When everything comes and sets up, and you take your entry, it's going to go. So have a really, really great evening. Even if you don't come aboard, I still hope you took away information here. And if you become part of our trading family, I promise to give you great information and get you into great trades. So have a really nice evening, and I look forward to seeing you, and I wish you all the best of luck. Take care, everyone. Bye-bye.